Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. We have a lot to cover. Let's jump in. And first up, we begin in North America. President Donald Trump's announcement this week of a 100% tariff on movies produced overseas has jolted the entertainment industry, raising questions about the future of global film production and the potential fallout for US media companies. The plan, unveiled in a Truth Social post, is part of Trump's broader America First agenda and aims to revive domestic film and television production. But critics warn it could backfire, damaging Hollywood's global footprint and sparking international retaliation. Trump declared that the Department of Commerce and his trade representatives would begin implementing the tariff immediately, framing the move as essential to national security and cultural integrity. Quote, "We want movies made in America again," he wrote, arguing that foreign productions serve as vehicles for propaganda. However, the post was vague on critical details, such as whether tariffs would apply to films partially shot abroad or to foreign language content licensed to US streaming platforms. Hollywood insiders were quick to voice concern. Shares of major media companies fell on Monday. Netflix and Warner Brothers Discovery dropped around 3%, while Paramount Global and Disney slipped about 2%. Analysts at Barclays warned the policy could, quote, harm the very industry it is supposed to help, end quote, noting that the US exports 3 times as much filmed content as it imports. Policy could complicate international productions too, which have become increasingly common due to cost savings and generous tax incentives in countries like Canada, the UK, and New Zealand. Films such as Avatar, shot in New Zealand, and the upcoming Fantastic Four: First Steps, shot in the UK and Spain, could be caught in the crossfire. New Zealand officials responded with alarm. One official questioned whether the tariff would target local productions or US films made abroad. Prime Minister Christopher Luxon defended the country's screen industry, which has produced films like The Lord of the Rings, citing its world-class talent and technology. Meanwhile, China has already reduced the number of American films allowed into its market in response to earlier tariffs. A broader global backlash, potentially including European taxes on US streaming platforms, could follow if the policy is enacted. While Trump's move is framed as pro-American jobs, it lacks clarity on how it will address the root causes of offshoring, namely high US production costs and labor expenses. Without new federal incentives, studios may still find it financially unfeasible to film stateside. The Motion Picture Association, representing major US studios, has yet to formally respond, but industry observers fear the tariff plan could isolate Hollywood just as global audiences are becoming more central to its business model. For now, the US president's proposal raises questions and leaves Hollywood bracing for a potential trade war of its own. Next up, we now move to Asia. Singapore's ruling People's Action Party, PAP, secured a commanding victory in Saturday's general election, a result that underscores public support for Prime Minister Lawrence Wong's economic stewardship amid mounting global uncertainty and rising domestic costs. The vote, Wong's first electoral test since assuming office last year, saw the PAP win 87 out of 97 seats in Parliament and boost its share of the popular vote to nearly 66%, up from 61% in 2020. The PAP, which has governed Singapore uninterrupted since independence, indeed Singapore has been criticised for lacking robustness in its democracy, the results mark both a political endorsement and an economic vote of confidence. Since the last election, the party has pursued an expansive fiscal agenda, channeling billions of dollars into subsidies, public housing access, cost of living relief, and infrastructure upgrades. Saturday's win affirms voters' willingness to trust that strategy as the city-state braces for slower growth and external trade shocks. Singapore's Ministry of Trade and Industry recently downgraded the country's 2025 growth forecast to a range of 0 to 2%, citing escalating global trade tensions and softening external demand. That comes after a 4.4% GDP expansion in 2024. The government's response, outlined in a 124 billion Singapore dollars, 95 billion US dollar budget this year, has included supermarket vouchers, elder care subsidies, and long-term investments in transport and logistics, including upgrades to Changi Airport. The economic stakes are high. With an open, export-oriented economy, Singapore is uniquely vulnerable to the fallout from US President Donald Trump's renewed trade reset, especially as the country attempts to balance ties with China, its largest trading partner, and the US, its top source of foreign direct investment. Quote, "Despite our limitations as a small state, we cannot afford to be passive bystanders," end quote, Wong said in a recent speech, emphasizing Singapore's need to remain nimble and assertive in a shifting geopolitical landscape. Voter anxiety over inflation and job security appears to have worked in the PAP's favor. Wong's administration has tightened foreign labor rules and broadened social safety nets, particularly for younger and lower-income Singaporeans. These policies appear to have blunted opposition gains, with the Workers' Party winning just 10 seats. No change from 2020, despite fielding new candidates and increasing its popular vote share to nearly 15%. As global headwinds intensify, Wong now faces the challenge of sustaining confidence while steering Singapore through volatile trade currents and slowing growth. With a fresh mandate and supermajority, he has the political capital to push ahead, but the economic realities will test his leadership in the months to come. And indeed, the world is going through tremendous transformation. If you want to be on top of the most up-to-date analysis on this change as we move through it, as we live history, consider subscribing to Market Update. Hit the bell notification icon and you will have a balanced digest from the three most dynamic regions in the world, North America, Europe, and Asia, so you have a well-rounded understanding of these great changes that we are living through. And if you're getting some value from today's episode, don't forget to hit the like button. Now, if you will forgive the indulgence, I would like to cover one more Asia development before we move on to Europe. Taiwan's currency has posted its sharpest two-day rally in decades, driven by a combination of hedging activity from life insurers and mounting speculation that a future trade deal with the US might include exchange rate provisions. The new Taiwan dollar surged another 2.5% on Monday, extending its two-day gain to 6.5%. Since early April, it has appreciated nearly 10% against the US dollar, a rapid climb that has rattled exporters and insurers alike. The rally comes amid concerns that the ongoing US-China trade war is having broader global effects. In Taiwan, fears are growing that the country's strong trade surplus with the US, $74 billion in 2024, could prompt Washington to push for a stronger currency as part of a broader trade agreement. Taiwanese President William Lai Ching-te moved quickly to downplay the speculation, saying in a video message that the country's surplus, quote, naturally, end quote, would not be discussed in US-Taiwan negotiations. Taiwan Central Bank also denied any request from the US Treasury for a currency adjustment, calling such claims, quote, speculation, not fact, end quote. Still, analysts believe market dynamics tell a different story. BNP Paribas strategist Ju Wang noted that exporters are, quote, panicking, end quote, and life insurers, heavily exposed to US assets, are scrambling to hedge unprotected currency risk. Taiwan holds $1.7 trillion in overseas assets, much of it in US bonds, leaving insurers vulnerable to dollar depreciation. Wang added that the central bank's relatively muted intervention, quote, fuels speculation that currency valuation is part of the trade talks, end quote, especially in light of past US concerns over dollar strength. The rapid appreciation has already hit markets. Shares in Taiwan Semiconductor Manufacturing Co. fell 1.3% on Monday, with analysts warning that a stronger Taiwan dollar could erode profits for the country's export-heavy technology sector. And finally for today, Europe and UK companies are beginning to quantify the fallout from US President Donald Trump's sweeping tariffs, warning investors of a deteriorating business climate marked by declining consumer confidence, disrupted supply chains, and prolonged policy uncertainty. Multinationals, including Nestle, Mercedes-Benz, and Unilever, are among those that have sounded the alarm in their latest quarterly updates, issued in the weeks following Trump's April 2 Liberation Day event, where he imposed imposed a baseline 10% tariff on nearly all trading partners, with reciprocal tariffs climbing significantly higher for many. Although the most severe tariffs, with the exception of those on China, have been delayed for 90 days to allow space for negotiations, executives say the uncertainty alone is having a chilling effect. CEO of Nestlé's Americas business told analysts that consumer sentiment was already subdued earlier this year and that the trade war had deepened pessimism. Quote, uncertainties created by economic policies, trade wars, and financial market evolution have increased concerns, end quote, he added. According to data from FactSet, European companies mentioned tariffs 223 times in earnings calls in April, nearly double the tally from March, underscoring how rapidly the issue has become central to corporate strategy and investor concerns. Jasper Brodin, CEO of Inca Group, which owns most IKEA stores worldwide, said companies were struggling to keep up with the pace of policymaking. Quote, there's no way IKEA can adapt its footprint or pricing strategy on this type of time horizon, end quote, he told the UK-based Financial Times over the weekend, noting that strategic decisions such as factory placement typically take a decade or more. Several automakers, including Stellantis, Volvo Cars, and Mercedes-Benz, have withdrawn their financial forecasts entirely, citing low visibility and an inability to plan long-term. Quote, you are starting to see companies making statements about low visibility and unwillingness to make long-term plans, end quote, said Fabiana Fedeli of M&G Investments. Currency volatility has added to the turmoil. Unilever's interim CFO called the recent steep decline of the US dollar against the euro, quote, unprecedented, end quote, and warned that exchange rate swings were now a material business risk. Meanwhile, companies with major US exposure are considering major adjustments. UK clothing retailer Primark, which plans to double its US stores to 60 by next year, is weighing shifting production out of China. But CEO George Weston said they were waiting for more clarity before making any supply chain moves. Trade negotiations between the US and EU have made little headway, with Brussels threatening retaliatory tariffs starting the 8th of July if a deal is not reached. The UK remains locked in talks with Washington. Executives warn that unless predictability returns, investment and deal-making will remain on hold. The cost of uncertainty, it seems, is mounting by the day. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you for another episode in a few days.